Ladies and gentlemen, I have the singular honor, without going to reintroduce the panel again, to moderate this webinar. I'm gonna save the panelists the time for pleasantries since Sonia has already done the introductions. So I'd ask that they would just delve into their topics, since we are um, running a very tight ship here today. So I'll just give you a quick outline of the program today. Unfortunately, two of our presenters are currently having challenges to join, so hopefully they'll join at some point. But at this point, we have Mas Manjang and Mr. Mohammed Manjang, both on the line. So the webinar in total would be 2 hours. Um, we'll have 5 minutes of introduction, which was already done by Sawane. Thank you so much. We'll also have 1 hour 30 minutes in total for the discussion between the moderator and the panelist. And then we'll have 20 minutes for Q&A, and then we'll have 5 minutes for closing remarks. Without wasting any much time, I will cede the floor to Mas Manjang to talk about his topic, Bank-Fintech partnership to bridge the financial gap in the Gambia's small and medium enterprises. Mas, the floor is yours.
Well, thank you very much, Bakari. Good afternoon to you, and also the introduce to recognize my co-panelist, Mr. Manjang, a senior, my senior brother. I think we are interacting on this webinar for the first time, and also Mr. Dominic Mendy, who is not on at the moment, but he is someone. So he's a mentor to me, I would say, to an extent, and I'm privileged to share this webinar with these distinguished personalities from the Gambia. Likewise, Mr. Sanyang, who is here to dial in as well. I also banking career. My topic that I'll be presenting on, as it is introduced, is on the banks, that is the financial institution, but specifically the banks and fintech companies. How could we, or financial and entities could partner to be able to bridge the financing gap that have been well as documented to having a major, to being a major constraint in the SME, that is a small and medium enterprise space. Timely in the sense that generally across the world, we have seen countries grappling with the challenges of growth. And this is, of course, on the back of the COVID in 2019, 2020, and also before still grappling with the ongoing Ukraine-Russia war. So I think it is quite apt that something like this is brought to the fore for us to dialogue on and share ideas how this particular segment, a catalyst for growth, which has been, I think, well documented by various international developmental organizations, including the UN. And I think generally SMEs have been identified to be a catalyst for growth in many countries, be it the developed country, developed world, as well as the developing world. And they have also importantly been identified to having creating entity. We know generally most developing countries, including the Gambia, struggle with unemployment, high rates of unemployment. Then I believe empowering this particular segment of our economy, which on important it is well documented that in terms of employment creation, SMEs generally tend to create about 60% of jobs globally based on the UNDP data. But even more so in developing countries where this ratio could be as high as 70%. So imagine that is coming from the SME. This is quite an important segment of the economy of most developing countries, especially in the Gambia here. So I think looking at the constraints or the obstacle and the obstacles that are faced by this particular segment of our economy, it's quite important, and I hope there are also some policy makers in our midst who might also be able to pick on one or two things from this and be able to see how best we could create that enabling environment for the SMEs generally. At the SME from the financing gap. Okay, so financing gap, it is generally agreed to be a situation where SMEs have challenges in accessing adequate financing to be able to sort of finance their do find challenges, and these challenges are because of a number of factors that I will delve into in a bit. And mainly it is because they are generally considered by the traditional banks as high-risk entities. The financing for most businesses come from the banks, especially in the developing countries, where our financial sectors are not well developed, they are not well diversified, and generally banks tend to be the dominant provider of financing for most businesses, even including governments. But generally, from the conventional banks, because of a number of factors, and one of which, of course, is that banks generally tend to characterize or group these entities as high risk. Okay, and also beyond that, they are generally seen as entities that have high transaction costs, and also in terms of data, they are seen as entities or businesses that do not have a lot of financial data. Okay, so when you generally come to the banks, banks tend to request for information, especially in terms of financial information, which because of the specific characteristics of people in the SME space, these are generally people who are from the informal sector of the society, and sometimes they are in fact from the disadvantaged or marginalized segments of our referring to, for example, I'm referring to the women folk, I'm referring to the youths, okay, and I'm referring to people from minority segments of our society that generally are disadvantaged by the mainstream economy of some of these countries that we find ourselves in. People, of course, try to get themselves lift themselves out of the poverty conundrum is to engage in businesses, and mainly these are small businesses that we're referring to here as SMEs. Sometimes they in fact expand it to enterprises. So these are generally businesses that, for example, could employ between micro could be 1 to 2 people generally. That's the standard definition, or sometimes small could be between 5 to 50, and beyond 50 could generally be regarded as large. But predominantly, most and more so also true for many developing countries are within this micro, small, and medium enterprises. So these are the financing to them, I believe, would empower this segment of our society to be better able to contribute advancement of the country that we are in. So when I look at some of the researches, because it's always good to look at what contextualize issues and see what are the current challenges, especially if we now should focus on Gambia specifically. There is this survey done in 2018 called the Gambia Enterprise Survey. And this survey brought out very interesting of the challenges that are generally faced by SMEs in the Gambia. Without so maybe just a few statistics I want to share with my audience, for example. And when I looked at this report, I was quite by how aggravated the situation is in the Gambia, even though I'm in the financial sector, right? It states that 72% of small businesses have identified access to finance as their main constraint to growing their businesses. So imagine up to 72% of businesses have constraint in to expand their businesses. That is, I think that's a damning statistics for us as a country, because if we are saying 70% of this segment of our economy provide jobs and they contribute meaningfully to having access to finance, only maybe about 18% could say they have access to some form of financing, generally from the banks in this case. And I think looking at the banking landscape in the Gambia, and when I'll come to that, but generally there is a high penetration rate in terms of banking in the Gambian context. So to say that up to 72% of our small size businesses and 40% in terms of a medium size have identified finance as a major constraint, I think this to the importance of something like this discourse for us to look at what solutions are there that could probably reduce this constraint or address them. And I think fintech perspective gives an interesting new innovation that I believe would also play its part in terms of growing this access or increasing this. Referring to the same survey, it also goes further to say that almost 84 about 84.6, which is very close to 85%, tend to rely on internal resources, okay? Because they do not have access to finance, most of them tend to rely on internal resources to finance their businesses and even to expand their business. 2%, based on the survey, said they have received some form of financing from the banks to expand their business. So only 3.2%. I think that's quite low by any standards and this is something that I think it should be something that should be at the forefront of our discussion in terms of how relevant, because I think the whole idea of banking is providing financial intermediation, and which includes providing the necessary resources to be able to help our business and the economy in general to be able to identify opportunities in the resources and the expertise to now create jobs and in the process lead to more economic advancement. Going further now on the banking sector specifically, Gambia generally we have 12 banks, like I said, and based on the data, some of the research documents that have been presented, there is tend to be a high penetration rate in the financial sector. So what do they mean by a high penetration rate? If you look at the asset book of the banking sector, for example, in 2021, it contributes almost 70% of the country's GDP is coming from the financial industry. 70% of the GDP is coming from the balance sheet of the financial services. So that means that there's a high penetration rate of the financial sector or the banking sector in terms of the country. That is quite significant. However, that is on the surface though, because now when you detail, if you go further into this further down, you realize that even despite this being very high by that metrics, you realize that it is concentrated in terms of the balance sheet of these banks. It is highly concentrated among portfolio investments for government and different from intermediation in terms of providing financing to the private sector especially. So it says that almost 30% of the, or 35% of the bank's balance sheet is mainly used to finance government. Okay, so these are in terms of government securities, for example, the bonds that we have now, meaning what basically banks are doing is they are mobilizing deposit and lending it to the government. Outside the private sector, as we all know, if the government is a major benefactor of the financial service, it does crowds out the private sector, and inside this private sector is where the real drivers of economic advancement is when it comes to macroeconomic development. So I think that is quite is something that is something to look at. Banks to be lending more of their deposits towards the private sector, because we know the private sector nowadays are believed to be the key drivers of development in most countries, and there's a lot of literature on that, and there's a lot of company agencies. How do we empower the private sector to be the developmental led to lead the developments of many of these developing countries, because we know they have a lot of advantage over the public sector when it comes to allocation of resources and all those not. So this is something that's I think we need to look at and see how can we make the banks more accessible, especially to the SME segment of our economy, because currently they are lending only about 12% to this sector. Further now, we look at I will now try to bring in the perspective of how do we leverage on fintech. Okay, generally fintech is a new phenomenon across many parts of the world, especially in the developing countries. We have seen financial technology companies services space, because we know there are inherent weaknesses in many financial institutions' ability, like I've alluded to meet the needs of many segments of the society, especially the business community. The upcoming of the fintech industry, I think they've been able to identify this gap, and with their innovation, many new, I would say latest advancements in the tech space, for especially, they have been able to use that to meet the needs of the underbanked population of many of the economies in Africa, especially. We've seen them how M-Pesa, for example, have transformed mobile financial services in Kenya, and not just M-Pesa, but we have others in many parts of the world. For in Rwanda, we have PayHippo in Nigeria, for example, we have Wiser Phone. So what these fintechs does is they are able to use their innovation and their understanding of the customer's needs, because they tend to and because of that, they are able to meet the specific needs of this part of the economy or the country that is not really addressed, or those that are not being served by the traditional banks. And this is also true in Gambia. Like I said, the financial intimidation in the country, in terms of even the access, most banks tend to have their branches around the urban areas, and in terms of presence in the rural areas, this is also something that is you have a lot of people, a lot of businesses that are underserved, and because they don't have access to financial services. Coupled with this, also other factors probably could be the technology or the level of development of our infrastructure as a country also, because a lot of banks tend to serve their customers by having opening up branches, for example, we all know, but we know cost of be high, and because of that, most banks tend to focus on populated areas that they believe they could turn this branch profitable, and in the process be also profitable. So they do not tend to serve communities where they do not establishing profitable entities. So what the fintechs does is that they are able to bridge this gap, okay, by providing solutions to financial institutions to be able to access these segments of the country effective ways, and also by their understanding of the customer, they're able to also have better customer service products and services. That way, these people can also, and in the process, I think it also leads to the financial inclusion that we all know it is something that is lacking currently, and we all need to put hands on deck to make sure more financial services. So I think generally there are two arguments in terms of how fintech can contribute to financial inclusion, or how fintech can increase access for finance for many of the SMEs. One school of thought is a whole replacement or a whole remodeling of the financial services, where fintechs will cut out the banks by providing direct financing to these end users, that is the end cost. And we've seen some fintech companies, generally like the Amazons and the Facebook, they tend to they have this sort of model where take out the banks out of the mix and be able to have direct access to the customers and meet their financial services. But also overwhelmingly, where I tend to subscribe to is there could be a form of partnership, okay, these fintech companies to be able to address the needs that are unmet, okay. And there could be a lot of there are a lot of opportunities where there could be this partnership. Tech company, like I said, they are quite innovative, they are quite agile, and they are technologically savvy. In the Gambia, but also in many developing countries, when it comes to innovation, they are usually not quite I would say responsive in terms of speed of innovation. So generally, banks tend to be very, they operate, and they sometimes suspicious of new technology or new ways of doing business. They tend to stick with what they are comfortable, and that because of that, most of them have not really embraced digitization. And I think for many, I think this is the way forward. Those banks that would be here for the long run, that will continue to be profitable to grow, we know, as a matter of fact, you need to invest in digitization services, because generally that is where the trend is going towards. And those banks that falter or that do not embrace the would, in the long run, or not even in the long run, will in some way, not too distant in the future, will find themselves in serious financial or growth challenges. So I think a partnership between a fintech company and a bank will be a symbiotic relationship, okay, in the sense that the fintechs will benefit from leveraging on the brand that these banks, because most of these banks tend to have been around for many years, and they have built a strong trust between themselves and their clients, and they tend to have generally very well recognizable brands. And the fintech companies coming in new without that much brand recognition, if they do partner with this financial institution, they can leverage on the brand and the trust that they have been able to grow, have been able to amass over a period, and that way people can have there could be more acceptance in terms of the services that they are going to provide to the SMEs. And from a business point of view too, generally it will bring efficiency for the banks, okay, because fintech companies are able to provide less cost intensive solutions. They are able to provide innovative solutions. They are also able to meet the needs of the younger generation. Generally, there is a lot of inroads in terms of mobile penetration in Africa. Most people, almost 70% of the population tend to have mobile phones. But when you look at financial intermediation, this is quite low. So these are very big opportunities that I think banks should recognize, that partnership between themselves and the fintechs can give them access to many unbanked segments of our society, and then also generally it will improve, or it will encourage or drive financial inclusion, which generally would tend to give more profitability for the banks. And in terms of the fintechs, they will have also a platform to be able to provide those solutions. So something like a partnership, I think is something that is interesting. It's something that works for everybody, and it's something that will meet the needs of the SME. Okay, what it does is generally why banks tend to perceive SMEs as high risk is because many SMEs, we know, they do not have legal status in the legal market. And sometimes the level of financial literacy among these SME practitioners is not the highest. It leaves a lot to be desired. Okay, and also so generally when there is this partnership between the banks and the SMEs, they are able to provide, for example, credit scoring. We know this is a key challenge for many banks in the country at the moment, because lack of financial information, lack of a database where customers can be able to register their businesses, and they could have share their data in terms of their credit history, is a big challenge. So when fintech companies are able to enter this space and provide credit scoring agencies or credit scoring platforms for these SME segments, I think banks can now rely on these platforms to be able to provide facilities to the SMEs. That way, banks are comfortable because they have financial information, they have a credit history of this fintech of these SMEs, and the SMEs also benefit because they are brought into the financial inclusion space, and they're able to access financing from the banks. So I think this is one area that we've seen many fintech companies expanding in other parts of the world, like I've alluded to earlier on. But generally in the Gambia, this is still at its nascent stage, and I'm not aware of any opportunity at the moment. I stand to be corrected, but this is one area that I think could be room for an opportunity for the fintech companies to enter. Another area is collaterals. We know generally 90% of facilities that are given out are collateralized, and these collateralizations are mainly in the form of properties. Okay, so SMEs usually sublet these properties to banks and other financial institutions to access loan, based on some of the eh, um, based on their motivation. Because some of these entities are informal, and they are operating at small level, like the name goes, small and medium-sized enterprise. So they struggle to provide properties on, and even lease properties. They don't ask for buy-to-let properties, they ask for lease properties. So one way that we could there could be a room or an opportunity to create more access for SMEs is finding alternative ways of Okay, securitization that could be provided in not just collateral, as we all know, in many developed worlds, other measures are used. Like credit scoring is one thing. We can look at their receivables, for example. We can look at their stocks. Okay, how can we provide platform, or how can we provide systems that can be able to provide inventory of their receivables or stocks that banks could now use, of course, with an entity, a regulatory body, and banks could now use these sort of platforms or mediums to advance credit to some of these SMEs. I think that's another area that is a major obstacle, not just for SME, but generally for many businesses in the country. Providing collateral is a major hindrance, and I think if we are able to have a partnership where the fintech could provide solutions in ways that SMEs can provide some other forms of collateral, I think it would be a very great thing for providing access or facilitating access for them.
Thank you, Mas. Can you
Yeah,
wrap up
Zachary.
in
Yeah.
3 minutes? In three
Yeah,
minutes?
yeah, yeah. Sorry. Yeah. Thank you
Okay.
very much. Yeah. So I'll try to wrap up now. So I think another area that I want to now focus on is the role of the government. I think in all of this, the government also has a role to play in terms of providing the enabling environment for both the banks and the SMEs to be able to have access. So this may not necessarily be providing developmental banks or agricultural banks. It may not really be necessary, because we know, um, based on the number of banks we have here, I think they have a lot of financial muscle, because generally the loan to deposit ratio, one of the key metrics, if you look at it in the industry, is less than 30%. It's between 25 to 30%, based on the latest industry data we have as at the end of June. So that leaves out more than 30% of deposits that could potentially be used to provide access to our business community. And rather than investing these in treasury bills or bonds, banks could better use these funds to provide financing to the SME segment, business segment, for example. So I think we need to have a regulatory framework for the fintechs, because, like I said, this is a new development, and in the Gambia, though I'm aware of the draft financial inclusion strategy that was released, but generally we know there are a lot of gaps, especially when it comes to mobile financial services, when it comes to fintechs. In terms of the regulatory framework, there is a lot of ambiguity and lack of clarity, and the regulation, is not well defined. So government needs to recognize the importance of digital financial services and provide the enabling framework by way of regulation that could really enable and facilitate people who are interested in this domain to get registered and play actively in this field. And also another area is to invest in the human capital, because this technology is highly skilled, requires highly skilled professionals. And one way to develop this or to capacitize this is to invest in the people, provide the schools, provide the resources and the facilities to be able to take up fintech education and be able to meaningfully contribute. Another area is in terms of the infrastructure. We know generally infrastructure by way of internet is a challenge in the country at the moment. And one way that government could help is to invest in the in the infrastructural requirements, be it in terms of especially on internet services and also energy. That is electricity. We know these are key drivers of development, especially in the fintech world. So these are other areas that I think governments can contribute meaningfully towards the advancement of financial inclusion and also fintech adoption. Last but not the least, also is to also I would say provide regulation, because we know fintech is generally new, and the success of fintech could also be its drawback, in the sense that they are very flexible and usually does not in terms of sophistication, they try to make the products very accessible and easy to use. And if it is not very regulated, the risk there is that it could be open to cyber security threats. We know generally there is a lot of threat coming from the cyber security of criminals who try to, for example, penetrate some of these financial services and be able to penetrate them and criminalize these activities. So I think there should be a lot of discussion around how can we make this tight in terms, but also generally, how do we educate the people to be aware of the risks that goes with some of these new innovations in the financial services. So this is not exhaustive, but just to point on some of the factors that I think could be meaningful in our own drive to be able to make sure there is for finance to the SME world, SME business segment, and also banks are able to play a greater role in providing finance to the business community. I would stop there here. Thank you very
Thank you
much,
so
Bakari.
much. Thank you
Yeah.
so much, Mas. Wonderful presentation. We'll use the next 3 minutes to go over questions. And the first question would be, um, um, how many banks in the Gambia have embraced this partnership so far? And if you can also share the challenges that they have faced so far in terms of building these relationships.
We have 12 banks in the country. I do not have an exact number of banks that have embraced these partners, but I know, top of my head, I know at least 4 to 5 banks are at an advanced than maybe or their other colleagues in terms of embracing these fintech partnership. And generally, these partnerships tend to in the way of mobile money. For example, there are partnerships with some of the telco companies to drive mobile money, but also generally, example, providing agency banking services, where they partner with some of these businesses, like it could be the bureaus, it could be these supermarkets that are high cash transacting entities, are able to also provide some form of basic banking services to some of the clients out there by way of, for example, depositing and withdrawing. That is also okay. So other generally we've seen that there are a lot of innovations coming into the financial services. Also, banks have also started embracing digital financial services, and they are partnering. Like I said, they have core competence in this area. So one way to do this is to partner with an existing fintech or yeah, generally with a fintech or a telco to be able to drive some of these areas. Also, another area that in terms of remittances. Like we all know, Gambia's economy is heavily reliant on remittances. And this is an opportunity that I think banks have also recognized, and they have gone ahead and to facilitate sending remittances remittances from the diaspora, for example, into their bank accounts directly. That could terminate directly into the bank account without the need to get codes, for example, and start roaming. These are some of the areas that we have seen banks playing, but we all know there is a lot more to do by way of, especially in terms of sort of cutting more accessible. Like I said, the financial intermediation is quite low, and I think this is something that banks should do more. And I think if we have fintechs that are interested in this, that are able to provide solutions, I see a lot of opportunity in furthering this financial intermediation, more access or more financing to the business community, but especially the SME
Yeah.
sub-segment.
Thank you, Mas.